So before I start, would like to tell you all that in my experience with risk modeling, I have observed that many graduates from prestigious institutions like ISI, IIT, and IIM, they face challenges despite their strong backgrounds in statistics and mathematics. This challenges often relates to understanding financial statements and interpreting financial ratios. They often miss to understand how to read an annual report or financial statements, which very helpful for them when they are building any risk related model, be it wholesale for corporates, retail, or bank and NBFC. So my sessions are designed for such loopholes or such gaps so that you all can understand. So there have been notable impacts on these ratios in our model, which can be very complex for even the most skilled statisticians as well as the mathematicians. So with this, let me show you y- the previous presentation. I have explained you all that how IFRS 16 has been implemented, what are the various fields where IFRS 16s are applicable, and how it will impact to the profit or loss account and the balance sheet as well as the cash flow statement. So if anything is impacting to the profit or loss account or the balance sheet, it means that the financial ratios are also impacted. So before I go through all that, what are the important lending based ratios or risk based ratios which are impacted post implementation of IFRS 16, I will show you that what are the organizations or what type of principal activity and what are the industry segment where IFRS 16 has a major impact. So these are the industries where IFRS 16 has been seen a major impact. These are airlines because lease are an important part of airline sector. Similarly, transport, travel and leisure, retail sector, because retailer, I have given you an example like Amazon, Flipkart, they will definitely opt for a warehouse rather purchase a warehouse. So they will avail that on a lease basis. Similarly, for the telecom sector, energy sector, healthcare, IT industries, these are the major 8 industries where IFRS 16 has notable or the significance impact. Okay, now let me go through the financial ratios where IFRS 16 has been applied. And those are related to the profit or loss account, cash flow statement, and the balance sheet. Okay, now the first metric is EBIT margin. EBIT is basically earning before interest and tax, which is nothing but the operating profit. What is operating profit? How it has impact? And how its significance, I will take a separate session, but for the time being let understand that EBIT margin will be impacted. EBIT margin, the formula is operating profit by sales. Now it will measure the profitability of an organization. Now after the implementation of IFRS 16, in my previous slide I have shown you all that the total rental expenses will be divided into 2 parts. One is depreciation and one part will be the interest expenses. And in order to calculate operating profit, we would only consider the depreciation expenses. So if we only consider depreciation expenses, it means that my operating profit will be increased because the expenses I will distribute into 2 parts. Depreciation is 50 and interest expenses will be 50. Previously, I used to update 100 as rental expenses. Now it become 50. It means that operating profit would increase. So that EBIT margin, because of the total rental expenses, it will be removed from the operating expenses and distributed between interest and depreciation. Okay. The second one is the net income, which is a major impact for the risk rating of a customer, be it corporate or banks. So net income. So these all are the risk factors or risk variables or the observations which we consider while we build our model. Okay. And on that basis, we run the SFA, MFA, or various analysis. Okay. Single factor analysis, multi-factor analysis, and all. Now, net income will remain the same because only changes will happen in the operating profit. Now, asset turnover, which again measure the profitability. Assets, the formula is sales by total assets. Now, it will be decreased. The reason being, in my previous session, I have mentioned that there will be an additional asset will be added in the face of the balance sheet as right of use asset. So when we are adding an extra asset, it means my denominator will be increased, which will simultaneously decrease my overall ratio. Now, leverage ratio is very important for every industry, all the segment. Okay. Now, leverage are basically two types. One is gross leverage and one is the net leverage. So the gross leverage, which ultimately measures the solvency of an organization. Based on that, a lending organization, suppose like a bank or financial institution, first they will calculate the solvency of the borrowing company or the borrowing fund, borrowing firm or the obligor. Okay. Then they would decide whether to lend money or not. So the solvency ratio would be calculated by total liability by total asset. Total liability will also be increased because right of use asset, in my previous session I have explained you all that loan will be added, and similarly a right of use asset will be also added to the balance sheet asset side. It means that liability total asset equals to total liability. Balance sheet would be reconciled. It means that there will be no impact. Now, net leverage, again, it is a part of the solvency, which measures the solvency. The formula is net debt divided by EBITDA. Now, what is net debt? Total debt minus all the cash and cash equivalent. It can be marketable security, bond, debenture, any sort of investment, treasury bill for a company bank, okay, which are short term in nature, and we will exclude. So now the net debt will also be increased because my debt side will be added by my lease liability, and EBITDA is calculated based on the operating profit. I will take a separate session for EBITDA and operating profit only. So for the time being only, just understand that since EBITDA here is calculated based on operating profit, there are two types of EBITDA calculated, two types of, one is EBITDA based on operating profit, one is based on EBITDA net profit. But the most organizations and the accounting standards, they considered EBITDA based on the operating profit. So operating profit, since it will increase, it means that EBITDA will also increase. It means that the ratio will not be changed. Now the interest expenses, which ultimately signifies the coverage of a firm. Okay, like interest service coverage ratio, debt service coverage ratio, all are important lending based ratios which calculated by all the bank or financial institution before taking any decision whether to lend money or not. Even if bank or financial institution they have lend money, it is their responsibility to check whether the borrower will timely pay interest as well as timely pay the principal, so for which these two important coverage ratios are required. Okay. Now interest expenses will be increased. There are two ways we can calculate coverage ratio, interest coverage ratio. One is cash flow from operation divided by interest expenses. Cash flow will be increased. The reason being, previously we used to update interest. In my previous slide, which I have mentioned that interest on lease expenses will be removed from the CFO calculation, cash flow from operation calculation. Okay, after the implementation of IFRS 16, it means that cash flow from operation will be increased, and interest expenses will also be increased because interest on lease liability, the additional loan which we are showing in the liability side for which we are paying interest expenses, that would also be increased. So Both will be increased. Now, another ratio to calculate interest coverage is EBITDA divided by interest expenses. EBITDA, I have already explained, will be increased. Interest expenses also will be increased. Debt service coverage ratio, fund from operation. I will take a separate session on how to calculate fund from operation, free cash flow from operating activity, and how it has broader impact to an organizations. But for the timing, FFO is basically calculated based on CFO. Since CFO is getting increased, so FFO will also be increased. And net debt, here also I have explained, net debt will also be increased. It means both will be increased. Now, debt service coverage ratio, I have explained. Now current ratio, current asset by current liability, which is again part of liquidity measurement. Okay. Now, current ratio, current asset will not be increased because right of use asset we are showing as part of non-current asset, not current asset. However, we are showing lease liability, which is in the current portion of the lease liability, we are showing under current liability. It means my denominator will be increased. So the whole effect will be my decrease in the overall ratio. Okay, so these are the basic ratios which got impacted post the implementation of IFRS 16, and accordingly all the model developer, when we are at the phase of redeveloping a model or developing a new model, we are considering and incorporating every changes. Okay, that's it. That's it from today's sessions. I hope you all enjoyed. Thank you for your precious time.